Hi, my name is Howard Way, if you guys don't know, and my advisor for the project was Professor Adam Gurin in the economics department. So the topic of my project is on monetary policy implementation. Specifically, more recently, following the Great Recession, the Federal Reserve has used some new tools, and I'm trying to assess whether those tools are actually being used effectively. Do they work? If they aren't working, what might be causing them not to work? And ultimately trying to come up with some policy recommendations so we can have functioning monetary policy and not have another financial collapse. So just some background. As I just previously mentioned, the collapse of the economy in 07 to 09 really called for the Federal Reserve to start using some new tools that they previously didn't use beforehand. So as you can imagine, in the news, people talked about quantitative easing, which you might have heard. And all of these really shifted the way that the Federal Reserve operated within the financial markets. The specific tool, though, that I'm looking at is this tool called the reverse repurchase agreements, which I'll be calling RRPs for short. So now that the economy has, as we consider, has improved, we are out of the recession, and the Federal Reserve is looking to raise interest rates, right? We don't want to keep interest rates too low for too long because that can cause a lot of unexpected growth within the economy. So the big way that we're trying to control this is using this new tool, which are the RRPs, so that the Federal Reserve can really control the interest rate. So the biggest issue, though, is that banks have a lot of cash, right? As you might have heard, people, really derided the Federal Reserve and said, well, you guys are printing a lot of money, so that has some negative consequences. That has some truth to it. Banks right now are sitting on a lot of cash within their reserves, and as you can imagine, one of the key functionings of banking is that at the end of the night, they have to make sure that they have a certain percentage of the reserves held at the banks, in case the economy collapses again. So the fact that they have large amounts of this cash means that there's a lot of trading within the overnight markets. So this is why the Federal Reserve has to use these new tools called the RRPs, or the reverse repurchase agreements. So the biggest thing is that the Federal Reserve hasn't really used RRPs before. So these are completely new. Some other central banks in other countries have used them, but the structural issues with different countries makes it difficult to say that it will definitely work in the US if it's worked in, for example, Europe. But they have tested it stealthily for the last 2 years without telling people too publicly about it. And they have actually formally implemented this policy tool when they announced that they're raising the rate in December of last year. So the question is, what are these RRPs? I actually won't get into too much of the mechanics of it, but I think the best way to conceptualize them is just think of them as a loan provided by financial institutions to the Federal Reserve. So what happens is the Federal Reserve says, I want to borrow X amount of dollars. The bank will give X amount of dollars to the Federal Reserve, and in return, the Federal Reserve says, well, here's some other assets that you can keep. These are typically U.S. Treasuries. So in terms of U.S. Treasury, I can't bring a U.S. Treasury to my grocery store and buy bread, but I can take cash and go to the grocery store and buy bread. So functionally, what they're trying to do is using these loans, they're trying to switch out how liquid I can use my money. Can I use my money to lend to other people, or do I have to hold on to them and I can't lend them out? So that's the functional mechanism that the Federal Reserve is playing with. And the big thing is that the Federal Reserve is believed, globally, to always service their debt. So when they say, I will borrow $100 and pay you 25% interest rate, people believe that they'll pay the 25% interest rate regardless of what happens within the economy. So this is considered the safest asset across the globe. So this is why the Federal Reserve is able to engage in these operations and set this kind of rate and set this what we functionally call a riskless rate. So financial institutions know that if I engage in this trade with the Federal Reserve, I will get this guaranteed rate. And I know this for sure. So I don't have to go play or speculate in the stock market in order to gain returns. I know I can definitely get whatever rate that the Federal Reserve gives me on the RRPs. So the question is, so by setting this rate on the RRPs, they can set the lower bound of interest rates, right? If they say, I'm giving you this RRP at 25% on your money, no one's going to look for no one's going to sell you money for 20% interest rate, right? If I can already earn 25% at the Federal Reserve, there's no reason for me to lend you at a lower rate. So that's functionally how these tools are being used by the Federal Reserve to control the level, to control these short-term interest rates. So the Federal Reserve functionally says, if I want the interest rate to be the lower bound at 25%, I will set it at 25%, and that way no one will trade below 25%. So the issue, though, is that this hasn't had as so during testing period, they saw that it worked out really well. So the rate that they set on the RPs was never pierced. It was always the rate that they set. So the Federal Reserve said, well, this looks like it's a pretty good rate. It's a pretty good tool, and let's use it. So the issue, though, is that with new regulation policies, there's actually been the appearance of new monthly spikes. So what we're seeing now, though, is that during the middle of the month, we're controlling rates pretty well. At the end of the month, we're getting really, really close to the lower bound that we set on these rates. And that's sort of where my paper comes in, and we're trying to understand, how severe is this? Is this actually an issue? How big is this interaction between regulation and the monetary policy? Because in my perspective, this is sort of where we can see this tool fail, where people, for some reason or another, are willing to trade below the rate that they set on the RRPs. So just to give you some graphs, as we all do in economics, you can see, so this trend shows from September 2013, which is essentially when they started the testing of RRPs, to September of 2015, which is the data set that I'm using. So during a majority of the testing, the top one shows the effective federal funds rate, which is the short-term interest rate that the Federal Reserve is trying to control. And there's some random variation, as you'd expect, within the markets, and that is also due to them increasing and decreasing the rate on the RRP. But then, starting at the end of December 2014, we suddenly see these very, very noticeable end-of-the-month spikes. And that's sort of where the interesting question becomes, why are these spikes happening? Why is there this reason that the Federal Reserve isn't able to control the interest rates within the bounds that they did so beforehand? And these spikes, though, also coincide with the amount of RRPs being purchased. So we do see that a major driver of this is the RRPs that are being used by the Federal Reserve. So my hypothesis, though, is that the regulation that is propelling this is this new regulation called Basel III regulation. So this is causing banks to actually, they have to report on some more capital requirements at the end of the month. So the need to report these changes the way that they're behaving, and that's sort of the hypothesis that I'm trying to test within the paper. And as you can notice, the top cap isn't really as pertinent to this, but it's just the monetary policy was shifting a little bit. So in order to control for the same type of monetary regime, we only constrain to the dark blue region of the timeline. So we only look at those observations. And then within those, we look at observations that fall under Basel III and observations that don't fall under Basel III. So that way we can test between the effects of the different regimes. So what does the Federal Reserve say? So obviously there's a lot of smart economists at the Federal Reserve. You'd expect them to have some sort of idea behind what is happening. So Simon Potter, the executive VP of the Federal Reserve Bank of New York, claims that when we did see the effective federal funds rate dip outside of our target range, he said, well, this is no big deal. This is just happening at the end of the month. We just think banks are changing their behavior slightly now, but this will be rectified in the future. So this is where I think the question becomes really important: is this effect really transitory, or is it something that is more persistent within the financial markets that we actually should care about? So what is my methodology? At the end of the day, so what I'm trying to do is I use the trade data that the Federal Reserve publishes for their RRP operations and try to test, is there a significant difference at these end of the month during the regulation? So if this is true, if we are seeing this significant difference, then that's very clear evidence that this regulation is causing financial institutions to change their behavior and change the way they interact with the RRP tool, which means that in the future, the biggest issue is that Basel III is going to move to daily reporting. So right now, Basel III is only monthly reporting, so that's why we see these end of the month. But if they move to daily reporting, then that can become a very serious issue if we don't shift the way that we're doing conducting monetary policy. So the two data sets I consider are first the overnight RRP. So overnight RRPs are just RRPs that are traded daily. So I would engage with an RRP contract with the Federal Reserve, and the next day I'll get my cash back. So it's a one-day loan. And then a term RRP is a longer term loan. So that could be 3 to 4 days, et cetera. So the first data set only looks at these overnight RRPs, and the second one looks at total outstanding. So on any specified date, it will look at the amount of overnight plus any additional term RRP that hasn't been resolved yet. And the reason why we look at the second one is because it includes the data period after the Federal Reserve has increased their interest rates. So this is a little different, this is outside of the testing area now. This is where the Federal Reserve is actually using them to implement policy. And we look at essentially the basic model is we try to estimate demand. Very simple, we're trying to see, is demand changing? Are the financial institutions, do they change the way that they purchase RRPs? So we come up with a basic model of price on quantity. As you can imagine, there's a supply curve and a demand curve, and we're just estimating demand curve. But the second, more in-depth equation you see on the slide is where we are controlling for different regime effects. So we have your demand curve in the middle of the month without regulation. You have your demand curve with regulation during the middle of the month. You have your demand curve at end of month without regulation, and you also have your demand curve at the end of the month with regulation. And what we're really trying to see is, at the end of the month with regulation, is there a different demand curve? And is this demand curve shift really significant? Some additional considerations is the Fed fixes their RRPs at 25 basis points. So we want to vary that. So we introduce a different price term to introduce market risk, and that's just constructed as the overnight GCF repo rate subtracting the overnight RRP rate. So this gives us some more variability. And of course, when we're estimating price and quantity, there's always an interaction. So we might not be necessarily measuring the true demand curve. However, this is we use other controls to mainly solve for this in the paper itself. But essentially, our main conclusion is this big regression table. We find that there's very significant effects at the end of the month during Basel III. And probably a much better way to conceptualize this is you see here these 4 different regimes. The orange line is where you really want to concentrate on, and that's where at the end of the month, people are very insensitive and they will purchase as many RRPs as possible. So we see that the end of the month effects is actually very significant, and it's not a transitory effect that we are currently seeing within the literature at the Federal Reserve. And this is just showing you a little bit more breakdown. We are able to break down by counterparty. So we have different banks, we have money market funds, et cetera, and we see that non-bank institutions are the main ones driving this. And this is mainly more so for the policy recommendation that we come up with. So the main conclusion, regulation effects are not transitory. We want to be able to check for them. So we have a threefold policy recommendation on how we can change the mechanics of the RRPs. These also get a little technical, so I won't get into too much detail due to time, but that's the project. So thanks so much for listening, and yeah. I think that's time, so if you guys have any questions, feel free to ask later.
Can you explain your project in 2 sentences?
Not really. So in 2 sentences, we're testing if the current implementation of the Federal Reserve in terms of increasing interest rates is working. And we find that it is not working due to regulatory impacts or impacts from new regulatory requirements.